when I was here as a college student, I remember reading all the books, you know, Think and Grow Rich, Psycho-Cybernetics, all of these things. And it's really funny. About a couple months ago, I got a comment from someone who knew me back in college, and they said, "You were really into this positive mental attitude stuff." And I remember back in college, I remember reading this Invictus by William Henry. I remember thinking, this is just really cool poem. In the felt clutch of circumstance, I have not winced nor cried aloud. Under the bludgeonings of chance, my head is bloody. Matters not how straight the grade, how charged with punishment's control. I'm the captain of my fate. I'm the master of my fate. I'm the captain of my soul. And it wasn't until probably about 10 years ago that I read this response from Orson Welles. He says, "Art thou in truth? And what of him? Who bought thee with his blood, plunged into devouring seas, and snatched thee from the flood. Bore for all our fallen race that none but him could bear. God who died that man might live, and then his glory share." You can read through the rest. This is just on the summary sheet from the today. But it's kind of interesting how my thought process have changed, where before it was, you know, positive mental attitude. You know, if I can think good thoughts and I can do this, then I can go and I can accomplish anything. And as I get older and I think I get wiser, I begin to realize it's not just thinking good thoughts. It's not just having that good attitude, although those things are important. It's really understanding on whose power we depend. It's understanding it's taking the atonement in our lives. It's understanding the power and the glory and the challenges there. Free will is not a free agency, a wheel for right or wrong. But thou must answer unto him to whom all souls belong. And to the dust that head unbowed, a small part of life's great whole. And see in him and him alone, the captain of thy soul. It's just important. You know, who is the source of our strength? You know, having a good attitude is important. Knowing that you can accomplish things are important. But really having that faith in the person who we should have faith on. And that's really the key thing. So that's my thought today. Today we are talking about insurance. And I wanted to just start off with what's required in this section. That's yours. So here's kind of our objectives today. We're going to talk about insurance basics. And then we're going to talk about life insurance. And so here's your section on insurance. And you're going to have five different sections. Your life, health, disability, auto, and homeowner/renter's insurance. So realize each of these sections you're going to have a different one. So the first question is, do you need it? So each of those five, you'll answer, do I need each of those insurance? Second question is, do you have it? And how much should you have? Third question is, what type of it? What are the costs and coverage? What are the discounts and the specifics? I'd like you to include a copy of your CLUE report. How many people don't have a CLUE report? And it's a report very similar to your credit report. But it's the one that insurance companies look at when they decide whether to take you on as a client. I'd like a summary sheet of your health insurance and teaching tool 29, which is how much life insurance do you need. Now there's 50 different ways of people to calculate how much life insurance you need. And so I went through and I just put on one spreadsheet about 6 or 7 different ways, and then we just take the average of those. So realize that teaching tool 29 is just 6 different ways of calculating life insurance. No dime and a whole bunch of other ones. So I'm going to talk a little bit right here at the beginning. We're going to talk about insurance basics. What do we do? And then about the last 45 minutes, I invited Tyler Vonsawad to come in and talk about life insurance. So Tyler's a BYU graduate. I see he brought his personal financial plan that he did. How many years ago was that, Tyler?
7?
7 years ago.
December 2005.
2005. So hopefully he's updated at least a little bit of it since then. But we'll turn the remainder of the time over for him. So let's talk a little bit about it. Let's see. Risk. Can someone define risk for me? How would you define it? Yes.
Uncertainty
Certainty?
of what will happen.
Okay. A lot of people think of risk differently. They think of risk, well, in my case, in the asset management class, we're managing about $900,000. And risk is the risk that we achieve a return that's less than the benchmark. There are some people who risk that they're concerned about the risk they're going to lose all their money. There's a lot of, there's the risk that you're going to get in a car wreck. There's the risk you're going to get sick. So what do we do with risk? Is risk bad? What do you think? Do we like uncertainty? Generally we don't. Can the results be bad? Yeah. So what do we do with risk? How do we handle it?
Transfer it to somebody else?
So we can do 4 things with risk. Number 1 is we can transfer it. We can do it through an insurance. Such as life or health, disability. Can you transfer all risks? It'd be really hard to. And would it be prohibitively expensive? It would. Now, let's take a look at life insurance. If I died today, my wife has got life insurance coverage. So if I died today, would that money make up for all the things that I do? Hopefully not. My kids would miss going skiing with me and hanging out with me and go playing on the quads and going bowling and all those other things. But it can transfer some of the financial aspects of it. So my wife won't have to work. So she can continue to spend the time in the home like that. So what other things can we do with risk? Yes?
Avoid it.
It's good. You can avoid it. You can decide not to go skydiving or scuba diving. Of course, I say that my wife and I are both scuba certified. You can avoid that kind of stuff. You can avoid high-risk occupations such as, construction. 50 times, high-rise, things like that. So you can avoid it in a lot of ways. What else can we do?
Embrace it.
Let's put that one out here. You can assume it. I used to have a 1973 Pinto, unsafe at any speed. When you drive 55 miles an hour, it seemed like you're doing 90. A little Mazda now, you drive 90, it seems like you're doing 55. But I did not have full coverage insurance on that. And so if I would have gotten in a wreck, who would have had to pay to replace the car? I had liability insurance, but not full coverage. In fact, a roommate borrowed the car, went up to Salt Lake, someone backed into him, and so came back and said, I'm sorry, someone backed into me, not my fault. Needless to say, I didn't lend him the car anymore, and so I lived with that dent in the car until I sold it. Pounded it out, tried to make it look as good as it was. What's the other thing we can do? We can actually reduce it. If you come into my house, you go into all the garages, there are fire extinguishers. In the back of my car, I have a fire extinguisher. I put out like 3 fire extinguishers. Fires in boats and cars and things like that. We can reduce it. How many people wore their seatbelts this morning when you drove to school? Reducing it. Anyone ride ATVs? How many people wear helmets? Trying to reduce it. I had a convertible Mustang. I put a roll bar on it. What am I trying to do? Trying to reduce it. So those are the things that we can do. We can transfer, we can avoid, we can reduce, or assume. When I think of risk, I like to use I like to use a little graph. And what I do is I divide risk into the frequency of loss. How often does this happen? And then I also look at severity of loss. So our options are avoid, reduce, assume, or transfer. And can you insure all losses? And the answer is no. It would be prohibitively expensive. But what is our objective? We basically want to insure against those things that would have a significant impact on our financial lives. So, high frequency, high severity. I'm not sure what something there. But what would we want to do that? So the severity is high and the frequency is high. I can't think of something right now that would be there. But what would we want to do? Probably avoid, reduce, maybe even transfer. How about high frequency, low severity? Give me an example of that type of a loss. Or that type of a risk. What's something that happens? Catching a cold? You know, how many people go get their flu shots? Things like that. So what would we do here? We probably, because it's low severity, we probably reduce it or assume it. Again, go and get flu shots. Trying to get more sleep, things like that. How about low frequency, high severity? What would you?
Death.
Yeah, so that would be death. So we, again, would probably transfer. How about low frequency, low severity? Probably the same. You know, paper cuts. But my point here is what we want to do is to be wise. Let me just share an email. It's actually a story. Last semester, a student came up, and this was about 3 or 4 years ago, and she says, I'm a home teacher of a young lady in my ward. So she's a single lady. She was probably like, 19 or 20 years old. She says she purchased cash value life insurance product about 3 years ago as a freshman. She's been paying $125 into it each month for the past 36 months, and her cash value portion was only $3,000. She's not sure if it was a good idea or not. Asked me for help. I just thought I'd come to see you and see what you thought. Interesting stories. And the challenge is there's a lot of things out there. There's a lot of things about insurance, and you hear one story, and the question is what we're hearing kind of the correct stuff? Realize insurance is a very interesting product. It can be tailored specifically to meet your needs. So all these products, there is a need for certain situations, and the key is to understand what situations you need that type of insurance. Now this person, as a freshman, she bought cash value life insurance. Was there really a need there? Probably not. I don't know. She may have had a medical uninsurability problem. But the point is we need to understand commissions on permanent products are about 10 times higher than they are on term products. Does that have an impact? Well, we as consumers, we should know that. We should understand the things we need to do. Someone made a comment. It says, insurance is never your best investment, and investment is never your best insurance. What do you think? Thoughts? Anyone use multifunction printers? It's a printer and a scanner and a fax. What do you guys think? Kind of good tools? Can be. But if you really want the best of each of those individual things, high quality printers, high quality scanners, things like this. And so what we want to do today is just kind of talk about some things and make sure that you guys are wise consumers over the things that we want to do. Any thoughts? What are the principles of being a wise insurance consumer? Again, the whys of personal finance, we've talked about those, it's the whats. And then what are the principles? So what do you think the principles are? Is insurance an easy product to understand? I actually heard someone who was very high up in the insurance industry say insurance companies purposely make it complex so you'll have to trust your insurance agent. And I have a brother who sells insurance. I'm not advertising, but I'm just making that comment. So it's something it's important for us to understand. And so let's talk about the principles. Number one is know yourself. What are you trying to do? What are you trying to accomplish with insurance? Someone said insurance is sold, not bought. But what's the reason behind it? You know what? It's a tool to help you achieve your goals. What are your goals? Which products will help with which goals? And realize your insurance needs will change. Number two, what's your budget? Your budget has a huge impact on this. This college student paying $125 a month into a cash value insurance, was that really a wise decision? Again, it may have been medical uninsurability. She may not have been able to get it any other way. I don't know. But to me, there's some questions there. Number three, understand in detail the costs and benefits. And that's really important. What are the costs and benefits of the product? And it's up to us. We're stewards over the resources we have. We need to be wise in that. Number four, basically we don't insure against everything. You know, only against high cost, high severity losses. Life insurance, you know, if you died, I would have an impact on my wife and my kids, my spouse and my kids. Health, you know, that would have an impact there. So we don't insure against everything, but we insure against high severity losses. And again, in most cases, keep insurance and investment products separate. Insurance is an interesting product. With investments, I can go back and I can check what are my returns on the mutual fund. Insurance, guess what? Do they make any predictions on what the fund's going to be able to deliver? No. And then, is there any way of recording what those are? You possibly can get it, but it's very difficult. And can the insurance contracts be changed right in the middle of the contract? And the answer is yes. So we need to be informed consumers. And then work only with high-quality individuals and institutions. Again, it's not just the cheapest cost wins. You want to make sure that the firm's around. And then the last one, review your needs annually. And so, a couple of things, you know, we talk about insurance. We talk about wills and things like this. And each time there's an area that I think we need to bring a professional in, I do. So I asked Tyler Vonsawad to come and to give us a view. Tyler works for an insurance agent. We won't say which one it is. It's not our purpose here. We're not pushing anything. But we are bringing him to give you some ideas and some thoughts and hopefully to make wiser choices. So we can be good consumers over the things that Heavenly Father has blessed us with. Can we have a big hand for Tyler? Oh yeah, got to mic you up. Got to tie you up. I put this behind you because otherwise I can't put it in my hands. Maybe I'm just uncoordinated.
Well, good morning.
Good morning. Good morning.
As I was walking into the classroom this morning, we've done this a few times, and it's been in different rooms. And I think this is the room that I had the class in back in December of 2005. So it brings back good memories. It's good to be on campus here, and good to be with you guys. So today we're going to have a discussion about life insurance. And I say discussion because I have a lot of prepared materials, but really we want to make sure that you guys get taught what you want to learn. And so we want to start off with any questions that you guys have about life insurance. And I don't know that I'm going to answer them all right now, but if there's a point during the presentation, we'll kind of go back to that question. So let's start off with some questions that you guys have. And if at any point you have a question on something, raise your hand. If I don't see your hand, just yell at me. Just say, hey, Tyler. And if it interrupts me, I'm totally okay with that. So questions that you guys have.
Well,
I guess, how long do you recommend getting like term life insurance? Like 20 years, 30 years?
Okay, so what duration of term insurance should you get? Okay, we're going to talk about that, so that's a good question. Other questions you guys have?
Is the death benefit that you receive, is that taxed? And if so, is it ordinary income or what?
Okay, so good questions. We're going to go over that as well. Let's see a hand here.
No, I just don't have a lot of exposure to it, like, it's just what's out there, what are the options?
So what is out there? What are the options? Okay, we're going to be covering that.
I was kind of curious, when do you get started even
When to get started?
getting it? Yeah.
Okay, so that's a good question. We're going to talk about that as well.
And who should you insure? Should you insure everybody in your family or just yourself?
Okay, so who should you insure? Everyone in your family or just yourself? We'll be discussing that. So good. I'm glad we're going to be answering a lot of the questions that you have throughout the time. If for whatever reason I don't dig deep enough into the questions that you had, as we get to that section, you'll know where it is. Then just raise your hand if you have additional questions about it. Any other things that you guys want to make sure we cover today? All right, let's get into it. Just disclosures, and they'll get a copy of the slides, right, Brian?
Yeah.
So,
I'll put it up.
okay. I'm going to be going through some of the slides fairly quickly because I know you guys will be getting a copy of them. Other ones we're going to stop and talk about for a minute. But the objectives really today are to find out how life insurance fits within the framework of financial security. What have church leaders said about life insurance? Which demographics need or want life insurance? How do life insurance companies work? How much life insurance is needed or wanted? What are the different types of life insurance? And what type of life insurance is most suitable for you? And what are the considerations to buying life insurance? So let's talk real quick. So Brian mentioned with an insurance company, we also do full service financial planning. So insurance is one of the pieces of an entire financial plan, and that's how it should remain. It should never be a separate product that doesn't fit with the rest of your financial plan. And so when we talk about financial security and we talk about life insurance, we want to make sure that life insurance is fitting within the framework of financial security and isn't just purchased as a product to be purchased outside of the other considerations. So when we talk about financial security, if I say those words, what does that mean to you?
I think of peace of mind.
Peace of mind, okay. I taught the priests for a long time, so I'm used to awkward, long pauses of silence, and I'm okay with it. So, but we do want to give you guys some opportunities to speak and ask questions, and again, really make this a discussion. Financial security, when I say that, what does it mean for you?
The question is death an excuse for not taking care of our families?
Good question.
I know that because I had a niece whose husband passed away, and she was 26 with one child, no life insurance.
So a niece who passed away, 26.
Actually, her husband passed away.
Husband passed away.
26.
No life
One
insurance.
child.
One child. A very similar situation to what I grew up in.
Going back to your question, financial security to me means like if something unexpected happens, like risk, or we've been talking about, are you going to be okay financially?
And if something happens to you, are you going to be okay financially? If these unknowns, these risk factors come in that we may not have a whole lot of control over, are you going to be okay financially? Okay, that's good. You mentioned peace of mind, right? What is it about peace of mind that's attractive?
Because you don't have to necessarily worry so much about what happens if you do die or something, you're disabled and can't work anymore. So I feel like it just gives you more confidence to enjoy life and go out and do the things that you want to do.
Yeah. So go out and enjoy life, do the things you want to do without worrying. It doesn't necessarily mean we take unnecessary risks and be reckless. I have life insurance. I don't need my seatbelt, right? Or we still want to be cautious, but it does allow us to do things more comfortably. And that may be as simple as boarding a plane to go on a vacation knowing your kids are left behind. When you've got your will and trust in place and you've got some life insurance, it's just, you feel more comfortable doing that. A lot of times we get calls, right? We're going to Europe, we're going to Hawaii, we're going to Mexico, and people are like, we just want to make sure everything's okay before we take off. So, we all like math in here, right? So if I use some equations, then that's okay. I mean, otherwise we wouldn't be here. Basic formula that I like to use is when income plus assets are greater than expenses, financial security generally exists. Right? When income plus assets are greater than expenses, then financial security exists. As you guys are younger, a lot of those expenses are going to be covered by your income. As you move and transition into retirement, a lot of those expenses are going to be covered by the built-up assets that you have, and less by income. And so if we can use life insurance to help with that equation by increasing our asset base if we die while we're young, then again, that's how it fits within the framework of financial security. So what have church leaders said about life insurance? They've talked about it for many years. Back in 1929, can I have a volunteer read this nice and loud?
Wise financial counselors teach that there are 4 different elements to any good budget. Provision should be made, first, for basic operating needs, such as food, clothing, etc. Second, for home equity. Third, for emergency needs, such as savings, health insurance, and life insurance. And fourth, for wise investment and a storage program for the future. May I comment on two of these elements? Nothing seems so certain as the unexpected in our lives. With rising medical costs, health insurance is the only way most families can meet serious accident, illness, or maternity costs, particularly for those for premature births. Life insurance provides income continuation when the provider prematurely dies. Every family should make provision for proper health and life insurance.
Okay. So again, in looking at financial security from some of our church leaders, taking care of basic operating needs, food, clothing, etc., home equity, building up some emergency fund, and making sure that life insurance provides income continuation if the provider prematurely dies. So someone asked, who should get life insurance, right? Should we insure the whole family? Is that you, right? Should we insure the whole family or just the breadwinner? This one talks specifically about the provider, making sure that the provider has life insurance to provide income. So we're going to read some other things that talk about some other pieces as well. Someone else?
Appropriately involve yourself in an insurance program. It is most important to have sufficient medical and adequate life insurance.
Okay. All right, so which demographics need or want life insurance? What do you guys think? What are your thoughts? Yeah.
So, I don't know, I think when you get to a point where you become dependent on your income, and it's kind of like you adjust to that lifestyle. For instance, if you, like right now, I'm married, but I have no kids, no mortgage. Like our expenses are so minimal that I don't have life insurance because I know that my life will be fine. But as soon as I have a child, and as soon as I buy a house and those things where she'll be pinned into those responsibilities that will seriously damage her credit or her life, if I were to leave, that's when I find it necessary to insure it.
Okay. So when you or you have dependents who are dependent on your income, that is kind of when a time where you would want to have life insurance. Yeah.
My wife is in Disneyland right now with Timpview High School students. Okay. So I have to run all the kids around. And I'm realizing how tough that was. So my kids walked to adolescent yesterday.
Yeah.
But boy, it's an amazing amount of work that our spouses do just to keep the home running.
Yeah.
And boy, if something happened to her, it would be a major challenge for me. And so we have life insurance for my wife as well.
And so your wife doesn't work outside the home, and so there's no financial dependence necessarily, but playing mom and dad at the same time while trying to bring in income can be very difficult, and she does provide a lot of financial value to try to replace a lot of the things she does, right? Even if it's being taxi service.
Well, she's gone for 4 days, and I already miss her.
So, yeah, I remember my wife went to girls' camp one year, and she came. I was her trying to manage the kids while I was at work. I was thinking at home. I was at home. I was thinking at work, and it was a difficult thing to do. She got back and I increased her life insurance. Well, let's talk a little bit about, there's some kind of terminology in the industry, the economic value of human life, which is the monetary amount created by an individual's current and future earnings or services rendered for dependents or organizations, right? We come up with these fancy definitions that belong in textbooks, right? That's one of them. What would be some examples of economic value created by the following individuals? The breadwinner of a family, we've talked about a little bit. Stay-at-home parent of a family, we just talked about that. What about a key employee of a business? What's their economic value?
Well, sometimes they have been around for so long in a company that they know so much about the workings of that company. Like I work for an accounting, or I do accounting for an engineering company, and sometimes I think like, not that I'm that irreplaceable, but if I were to die, it would cost them a ton of money to try and figure out all the things that I've learned over the last like 2 years, because it's just like you learn things like as you go.
Yeah. So to replace you, they would have to, one, figure out what you were doing, and then two, hire somebody to do the job that you were doing. And so there's a lost, there's opportunity cost that's there because it's not getting done, and there's a training cost that is entailed there as well. And for a lot of companies, that can be very serious. Generally, what we're looking at when we're insuring a key employee of a business is about 5 times salary. And so, again, that can be fairly substantial for some companies to be able to have some cash flow to weather that storm. What about a partner of a business? Yeah.
So a partner passes away, you could just like kind of pay out their spouse in order to get their share out of the company.
All right. So let's say that you have Bill and Johnny, who are partners in a business. Bill is married to Cindy, as Johnny is married to Mary, and Bill passes away. Who now owns the business? Johnny and where this other person? Cindy, right? What did I say? So Johnny and Cindy now own the business. Now, does Cindy know how to run the business like Bill did?
Probably, potentially not.
Maybe, probably not, right? Is she going to be as good? Does she have the right context? Does she have the right knowledge? Does she have the right skill base? Yet, she owns half the company, and half the profits should go to her for being half the owner, right? But you can see how that could create some friction with Johnny and with Johnny's wife, Mary. That can be difficult for them saying, all right, we love Cindy, we want to make sure Cindy's taken care of, but here we are 4 years later, we're still giving her half the profits. She's not contributing anything to the business. It's difficult to continue to do that on a long-term basis. So we have Johnny purchase a policy on Bill, Bill purchases a policy on Johnny, Bill passes away, Johnny is the beneficiary or receives the death benefit, tax-free, income tax-free, and then Johnny buys the business from Cindy. Cindy gets her money, Johnny gets the business. Everybody's happy, everybody's financially secure. A single retired owner of a large estate. If they die, they're old, the kids are grown up, they're fine. What do you think? Any economic value?
They can't sell the house. You're going to have the property tax and the death tax associated with the house.
All right, so the property tax and then potentially the death tax or the estate tax. So 2 words that mean the same thing. And so we see a lot of times there's a lot of words that mean the same thing. Part of it is death tax scares people more in the news than estate tax does. So if they say death tax, people are like, oh, what do I have to do? If they say estate tax, they're like, oh, they must be talking to lawyers or something, right? So the estate tax and death tax, essentially the same thing. The estate tax, does anybody know the 2013 exclusion or exemption, from the estate tax? How much can this single retired owner of a large estate pass down to the next generation when he dies before he owes estate tax?
5 million.
5 million plus a little bit of inflation, so 5,250,000. If he's married, then they can combine use 10,500,000 to pass down. So what happens if the single retired large estate owner, let's say he's worth $15 million, let's say 15,250,000 to make the math easy. How much does he get to pass down to the kids? 10,250, or excuse me, 10,250,000. How much is subject to the estate tax? 5 million. And how much does the government want in that estate tax?
55%.
40% is that right now. So 40% of 5 million? $2 million, right? And when do the kids or the inheritors of the estate have to come up with that money? Well, the IRS wants it in cash, and they want it 9 months from the time the person passed away. So if you had 15 million in cash, they might be all right. But generally, people with large estates, perhaps he owns a lot of land, perhaps he owns some real estate, perhaps he owns some things in the market, and in that time frame, would it be prudent to sell those assets and generate the cash sufficient to cover the estate tax? They need $2 million. That can be all right. It might be a difficult time. I don't want to be selling real estate right now. It just doesn't make a lot of sense. Or if he owns part of a business, again, do they have to look at selling the business to cover the estate taxes? So life insurance can come into play, and there's ways that we can set that life insurance apart so that it's not part of his estate, but can come back and pay the estate taxes from kids. So we won't get into too much details about that. But can economic value change over time? What do you guys think? Is it always going to be the same, right? The same economic value you have now, will that be the same forevermore? Or will it change as you guys continue to get your education and as you get in good jobs? Does your economic value become something different?
I think, yeah, just because if you look at a breadwinner and at 30 with kids at home, there's a high economic value associated with that, whereas you look at in the 60s, 65, not as much. Not as much. So someone who's younger, who has dependents, who is working and generating income may have a higher economic value than someone who is old and old. Is that what you're saying?
I resemble that remark.
So let me draw on the board here just for a minute. So what's the economic value of a child at that point in their life? Not necessarily saying what's the potential future economic value that person can create, but at that time, if they pass away, what costs, what income is lost, or what costs are involved? So funeral costs, medical costs potentially, and then any time off that the breadwinner, the parents would take to just get through things, right? So this is time, this is the economic value, probably pretty low, right? Does that change over the next several years? Right, when they're teenagers, they might become liabilities, and maybe a profit for the pathway, I don't know. But doesn't really change for a while. And then what happens? You start working, okay? And what else? Get married, have kids, right? So that jumps up a little bit. What else happens?
Get a house.
Okay. All right, so you get a house. So these are all things, you know how you have to write that 10-page goal sheet that you write. These are all these things, right? And then what happens? You get a raise, and you buy your other house, and you have more kids, or somewhere along the line you have more kids, and then what happens? Okay, you retire. Kids start leaving the house, right? Kids get married, and they may start leaving the house. They may come back, but so they start leaving the house, and your economic value starts to decrease for most people. For some people in the estate tax world, if they continue to grow and grow and grow their estate, their economic value actually might continue to increase. For others, it'll drop to nothing, pretty much to where there's just back where they were here, where funeral costs need to be covered. And for others, what we find is that for most people, they get to a point in their life, if they've planned well, where they're grateful for all the savings that they've done, and they've realized that they're not going to spend all their money, and they'd like to leave some behind. And so they maintain their economic value a little bit higher. So that's how it can change over time. And along with that, the need for life insurance in the respect of all of their other financial security. So in their, if we factor in the 401k savings and their other savings, the other assets that they have, that need for life insurance can increase and it can decrease as well. So how do life insurance companies work? I'm going to go through this fairly quickly, just because it's really wordy and there's a lot of numbers and things. But because the timing of a death can be difficult to predict, insurance companies are used to provide benefits when needed using a concept called risk pooling. And so this started out, there's different views on when life insurance actually started. A lot of the, I think it was the Roman soldiers kind of used it, where they kind of pooled together some of their funds, and if one of their buddies passed away, then they would just use that pool of funds to bury them. It then grew into helping them provide a little bit for their spouse and family, and then it got commercialized in about the 1700s. So, risk pooling, what that means, contributions made by a group of members with similar risk to offset the loss of one or more members of the group. All right, so similar risk. In this context, is the 20-year-old healthy person living the word of wisdom have the same risk of dying as the 65-year-old who's been smoking 2 packs a day for the last 40 years, right? Are those the same risks? No, they'd be in different risk pools. So, example of life insurance, this is, again, very basic overview. So, if we have, like I said, I'll have you guys go through this later. If we have 1 million 30-year-old males, and their chance of dying, each of them, is 0.1428%, that means of those 1 million 30-year-old males, 1,428 are likely to die, statistically likely to die this year. If each had an economic value of $2 million, we take 2 million, multiplied by all of those deaths, that gives us 2,856,000,000 of death benefits needed to replace the economic value. So requiring, again, if we divide that by a million, $2,856 of cost to cover a $2 million benefit. Right, so that's kind of an example of risk pooling. Now, life insurance companies create even more narrow risk pools, including but not limited to the following factors: current and previous health conditions, family history of health conditions, tobacco or other drug use, and hobbies and other avocations. That's kind of a fancy word of saying skydiving, scuba diving, or other dangerous activities, or activities that could be considered dangerous. So, in addition to these factors, premiums are also determined by policy type and duration, operational expenses, commissions, dividends, and even investment income. So death benefits, yes, go ahead.
I just have a quick question. Are insurance companies insured? You know, like if there's ever a natural disaster or like an epidemic, you know, everyone gets sick and dies, you know, are they insured? So we're insured to actually get our money, or?
Yes, on a couple different levels. So one is that I know we use reinsurers to insure some of the risks that we're not really willing to take on, but we are to a degree, if that makes sense. Like, they're on the border. We're like, we kind of don't want them, we kind of do. And so what we're going to do is we're actually going to send this out to reinsurance. So if this person passes away, it's actually a backing agency to us that's going to be paying the death claim. And then to answer the other question, if a life insurance company just goes belly up and they're completely insolvent and they're not going to be paying death claims, depending on state law, Utah, for example, has the Utah Life and Health Insurance Guarantee Association, in which they'll cover up to $500,000 in death benefits if the insurance company isn't around. Now, I don't know of many cases where the insurance companies have just disappeared and the policies have gone to that extent. Typically, they're acquired or they merge with another insurance company. So, but yeah, so there's a couple different levels on which that exists. Any other questions? All right. So death benefits can be paid out in a lump sum or monthly income stream that is guaranteed to last the life of your beneficiary, or a combination of both. So most recent death claim we had, or that I personally had, was a guy who was actually overseas when he passed away. His wife and 4 children were here, and he had $1 million of coverage, and we essentially gave her a checkbook that had $1 million in the account. So we're still working on what to do with that money because it was fairly recent. But those are some of the options, and it does come out income tax free. It's possible that it could be subject to a state tax if you fall within that realm, and if the insurance policy is owned by the insured or the person who died. If it's owned by someone else or outside of the estate, like we're talking about, again, we're not going to get into too much detail there, but it can be estate tax free as well. Any other questions you guys have? All right. How much life insurance do you need, or do you want? And should I say, I should have talked about this before. Do you need life insurance? Okay, so I'm married. I've got 3 kids. Do I need life insurance? Depends, right? Yeah, I hear a lot of yeses, a lot of probablys. They'd like it. If I died and I had no life insurance, would they survive? Would they figure it out?
How much do you have in debt?
They would, yeah, I'm sure I'd say that. Right? They'd make it. They'd survive. They might have to move. They might have to be hanging out with the bishop and asking them for, stuff more often. They might need even Social Security, other welfare programs that could be in there. And they can make it. They're good people. They can figure it out. Do I want to leave them in that position? No. Okay, so I have an argument. There's an argument that says you don't necessarily need life insurance. And so for the most part, when I talk about life insurance, we're talking about what do you want? What do you want to have happen? If you were to pass away, what do you want your family lifestyle to be like? Do you want it to be similar? Do you want it to be different than if you were here? Again, no amount of life insurance is ever going to replace me taking my kids skiing or playing games with them or tickling them. It's not going to happen. But it will replace putting food on the table, keeping a roof over their head, so that my wife, their mom, doesn't have to go out and work, and now they're losing 2 parents for a lot of the day. Right? So what do you guys think? What have you heard as far as how much life insurance should you have? There's rules of thumb that are floating out there. Bryan said he's got 6 different ways for you guys on the teaching tool. What do you guys think? What have you heard? Yeah.
A lot of times you at least need enough to cover your home mortgage.
Okay. So you'd like to have enough to cover the home mortgage? Okay.
It's like some multiple of your salary.
Multiple of salary.
Your debts.
We hear that a lot. Okay. So some multiple of earnings. I actually read in the paper this morning. Someone said a multiple get a multiple of 8 to 10 times your earnings. Yeah, I read that this morning. Any other thoughts? All right. So let's. I like this quote here, and it goes into that. That's fine. Just have someone read this out loud. Yeah.
Standard formulas such as buying coverage equal to 8 to 10 times your income are inadequate shortcuts. Online calculators are apt to tell you to raise your coverage by $1 million even if you already have insurance.
The truth is that life insurance is a personal affair. Two couples may earn equal salaries. Two couples may earn equal salaries, but it's silly to say that someone with 4 young children should have the same coverage as empty nesters with no mortgage and a substantial return.
All right. So I love this because, again, we don't get life insurance for the sake of just getting life insurance. To have a policy to say, I have life insurance, I'm covered, right? We get life insurance because we want financial security. We want it to provide peace of mind, and we want it to do the things that we want it to do. And if we haven't figured out what our goals are, it's difficult to come up with the actual number. So, how much life insurance is needed? This is, again, something else that found the ensign. Another volunteer read this.
Life insurance is designed primarily to give financial aid to the immediate families survivors after the insured person's death. Thus, insure the family breadwinner first, then others if desired as income permits. At a minimum, get enough life insurance to pay for things such as funeral, taxes, mortgage on the home, car payments, and other debts. The next priority should be to get enough insurance that, supplemented by any government retirement benefits their surviving spouse may be entitled to, there will be sufficient to provide for the family to make provisions for the children's education and missions.
All right. So someone asked earlier, again, coming back to this question of, who do you insure? Do you insure the breadwinner? Do you insure the whole family? It's up to you. What are your goals? What do you want to accomplish? Those questions will help create the answers to the other questions of who should we insure, right? Breadwinner first, and then if income permits, you can do the surviving spouse or the spouse and the children. And cover some of these things. So this is what we take a look at. We break it up, and when I meet with clients, break it up into kind of 3 separate categories. One is immediate expenses, mortgage, any other debt, funeral costs. Student loans, so that you guys know, if there are official student loans on you, are forgiven at death. So your spouses aren't forgiven at your death, but they're on you, they're forgiven at your death. So that is nice to know. What are some future expenses? Education, missions, weddings. And what about ongoing expenses? How much is needed after all these things are taken care of? How much is needed to be comfortable? And how long do you want the income to last? Do you want it to last 10 years and then stop? Do you want it to last 20 years and then stop? Do you want it to go for the rest of your life? Everybody's a little bit different. Everybody's a little unique. There's not one right or wrong answer. We do hear a lot of times, though, people say, well, my wife is 35. We just had our last child, and so 20 years from now, all the kids will be out of the house and grown. So maybe we should need income to last for 20 years. Well, how easy is it for a 55-year-old who hasn't been in the workforce to go out and get a job that's going to, 1, allow them to live on that income, and 2, be able to save up enough in that short time span for retirement? Probably not very likely. So it's important to kind of think, throw yourself in the future, put yourself out there and say, if I do this, this is what it will provide, and then what will life be like then, and is that the situation that I want to be in? So again, it's or to leave the family in. It's important to just understand what your goals are, factor that in now, and what they might be in the future as well. All right, different types of life insurance. There's permanent and there's term insurance. Anybody know the difference between the two? The name gives away part. Yeah.
Does permanent go till you die, and then term is for a specific period of time?
That's it. That's exactly it. So that's the real basics, and I'm going to go through this kind of quickly here. It's kind of like owning a home versus leasing a home. There's a lot of similarities. So when you own a home, it's permanent, right? You buy it, you live there, and as long as you make your mortgage payment, and once the mortgage is paid off, then you're there. There's some equity, you have a little bit more control, you can paint the walls, you don't have to get permission, do things. Your payments will stop at some point, or can stop at some point, and there's some tax benefits, right? Mortgage interest is tax deductible. When you lease, it's generally temporary. How many of you guys own a home? How many of you guys are leasing? Right? And there's different times where it's appropriate for different things. How many of you who are currently leasing plan on owning one day? Okay, so again, it can change over time. Leasing, generally less expensive per month. There's no equity buildup. You know, you're lucky if you get your deposit back, I guess. Less control. You have to ask when you can paint the walls or you know, hang something big or whatever. Your payments will continue as long as you want to live there. You better be making that payment. And there's not really any tax benefits. So insurance is kind of the same in that permanent insurance is more expensive per month. But instead of the home versus lease decision where it might be a difference of 10% or 20%, permanent insurance can be 10 to 20 times the amount of term insurance. So it can be a lot. It's more expensive, but a lot more expensive. There's equity, which we call cash value in the insurance world, if you've heard that term. It's the amount of money that you can essentially take. If you were to sell your policy back to the company, they would give you the cash value or the equity. You have more control. There's some other things that you can do. Like Brian said, you can change things midstream. Your payments on a policy can, I should change that to can specifically for insurance. There's policies that can be paid till a certain time, and then you own them outright, and you never have to pay anything more into them, but you continue to receive the benefit. And there's some tax benefits in that the equity portion of the cash value grows tax deferred, meaning that anytime there's growth that happens inside of that, you don't get a 1099, and you don't owe any taxes on it. So, at the end, when you pull the money out, there's potentially some tax consequences. Life insurance is a unique thing. You guys taken accounting classes, you learn about basis, right? And generally in investments, you're taxed on them each year, or when you pull them out, you're taxed on the gain. Life insurance is a unique asset in that the amount that you pull out first is part of your basis, so you're not taxed on it. Example, if you've put $100,000 into a life insurance policy and the cash value is $150,000, you can access that first $100,000 without paying taxes. Someone asks the tax question. If you do access the additional $50,000, depending on how you do it, you can get it tax-free through a loan, or if you just take it and sell the policy back to the company, essentially, then that gain would be taxed at ordinary income and not capital gains. Again, important to know. Term insurance is temporary, again, a lot less expensive, no cash value, a little bit less control and flexibility. As long as you want that coverage, you're paying for it, and a lot of tax benefits.
In about 12 minutes.
Okay, sounds good. So different types of life insurance, which type is better? I get this question all the time, right? Where there's all these different things, there's all these different possibilities of life insurance out there. Which type is better? Really understand your goals. Financial security is the goal, and you define what financial security means to you. You know what gives you peace of mind. You know what makes you feel, hey, if something happens, my family's going to be okay financially. Nobody knows that better than you do. And so not just having life insurance, that's not the end. Goal of life insurance, death benefit first. Focus on the death benefit first. I had a conversation with a client last night, and he was talking about, well, maybe, he was looking at some of the permanent insurance, looking at some of the term insurance. He said, maybe if we reduce the total amount but get more permanent insurance, then I'd like to see an option of that. I said, well, that doesn't really make sense, because if your wife comes and she tells me that you passed away, she's not going to care whether you had permanent insurance or term insurance. She's going to want to know how much there is. And I'm not going to want to have the conversation that says, well, there's this other type of insurance that has kind of cool benefits. So we reduced your overall death benefits so we could kind of get this one with some cash value. I said, that's not a conversation I want to have. So first and foremost, we focus on the death benefit, and then other benefits such as cash value, tax for growth, and everything else. Those can be secondary to the death benefit. Duration. How long are you going to have life insurance? how long you need it. I looked at an interesting study that our company put out. The death claim, because it was talking about how many death claims we had paid in the first year of a policy. So when someone set up a policy, how many of those people died within the first year? And it was kind of an interesting study. But they said, on average, most of our clients that we pay death claim on have been policy owners for 40 years. I thought that was kind of interesting. So, duration, how long are you going to have the coverage? And what is your ability to pay the premiums? So coming back to this example that you mentioned before, this gal, she was working, she was single, we're going to make some assumptions about her, right? And I don't know, maybe she was maxing out a Roth IRA, she didn't have access to a 401k, maybe she had some medical conditions.
No Roth back.
Okay, so then maybe she was maxing out her traditional, and maybe it was an attractive, and she had a fairly substantial income. And it made sense to look for other means of getting tax deferred growth. Maybe she was just a student who didn't have a lot of income, but also didn't have very many expenses. And how sustainable would that $125 be once she got married, had kids, and they were looking to buy a house and everything else, right? So understanding the ability to pay premiums is extremely important. I'm going to go through this fairly quickly. You guys can go through it later and go through kind of some different details. A couple different types of term insurance. Level and annually renewable. Annually renewable is kind of a way of saying, if you're 30 years old, or if you're 25 years old, what are the chances of you dying this year? If you're 26-year-old, what are the chances of you dying when you're 26? What about 27? What about 28, right? So it increases, your chances of dying increase exponentially as you get older. And that's kind of how annually renewable policy works. Your costs for insurance increase along with your risk of dying. A level premium policy just says, we're going to level out the premiums for 10 or 20 or 30 years, and it's going to be fixed. So let's take a couple looks at some ideas. This is $1 million of coverage for a 25-year-old male. This is the annual premium, so costs on an annual basis. This is a healthy person. This is a level premium policy. This is a annually renewable policy. We can see for the first several years it's less expensive, but then as that person gets older, it starts increasing more rapidly. If we take a look later on down the road, what are the options when someone gets past that first 25 years, right? Now they're 45 years old, thinking, well, I still want life insurance. One, they can continue on the annual renewable path, or two, they can jump to a new 20-year level premium. Now, if they're in good health, they get this blue line rate. If they're in decent health, they get this, I don't know what color that is. They get that rate. If they're in, okay health, but not the greatest, they can get that rate. And if they're really in poor health, there's a rate up there that they can get. So, coming back in for insurance, you can always apply for insurance. At any time, you can apply for insurance. But who makes the decision as to whether you get it or not? And at what rate? The insurance company, right?
So here's you came into again shopping around to different insurance companies, because different insurance companies price different risks differently.
They do. Yeah, some are more lenient towards smokers, some are more lenient towards people who have high blood pressure. It's just kind of interesting how those go. So these are some of the cost benefits. Again, I'm going to flip through this here because you guys have this. 10-year term policy, 20-year term policy, 30-year level term policy. There's annual renewable, which we talked about. There's mortgage life insurance. When you get, yeah.
Question about the term, I'm not sure if you understood it. So if I get like a 30-year term insurance, at the end of that 30 years, I still want insurance. So does that kind of like carry over to my new policy that I make, or does it just it ends, you lose all that?
It ends, you lose it all.
Well, remember, you've got 30 years of insurance coverage in case you die.
So it was good while I had it, but when I
lived
lived through it, then it's like, well, that was a lot of money that didn't. I mean, it would have been good had I died, but then it's just gone.
It's a pure insurance cost.
It's like your car insurance.
Yep, exactly. You hope you don't use it, but then you can't get it in.
Better to have it than not, but it's kind of unfortunate.
Exactly.
Again, the same thing about your car insurance.
Yeah. And right now, again, you said at the end of 30 years you obviously want insurance still. if you're Brian's age, which he said he resembles old and moldy,
108.
then a 30-year policy is probably not applicable, right? So again, understanding when the benefits are needed. And the thing.
And in my case, we've got sufficient assets. But even in spite of the fact that we have sufficient assets, you know, last year I went through and thought, you know, my wife wouldn't complain about another $750,000. So I went through with another, 10-year, just another 10-year, just until all my kids are out of the house. And again, what am I trying to do? I'm trying to take care of my wife. And, they will miss me, but if they have financial resources, they'd be able to accomplish it.
They'd be okay. They'd be set. If market risk kind of takes into factor a little bit more, they'll be able to weather that storm a little better. When you guys buy a house, you're going to get all sorts of things in the mail saying, check this box and send it back and pay this premium or whatever, and we'll pay off your mortgage if you pass away. So understand that that's another piece there. Yeah. Okay. Accidental death and dismemberment. This is a kind of coverage where you look at it and you're like, holy cow, I get $1 million for like $1.73 a month. And it's generally accidental death and dismemberment, meaning if you die in an accident and you have kind of a closed casket funeral, then that's when that type of policy would pay out. But we don't generally factor this in because we don't know exactly how you're going to die. So it's nice to have, it's cheap, it's easy, and that's fine. A lot of riders that can be on policies. On a term policy, you can have a convertibility rider, which you change it over to permanent insurance. The waiver of premium benefit, which waives the premiums in the event that you become disabled, can be very good. There's the accidental death and dismemberment rider, a rider that can allow you to purchase more coverage as you get older. A cost of living adjustment rider, so again increases the benefit each year. And then something also that can cover child benefits. These are all optional riders that you can choose from. Different types of permanent insurance. Whole life insurance, kind of the bread and butter type of permanent insurance. This was the insurance way back in the day. That was pretty much the only type. And then there's other, more recently, some universal life as well as some other variations kind of came into play. I put a chart here. Again, I'll let you guys go through this a little bit later. But this is great to understand what are the key features and when do you use the different types of insurance. So again, we're not going to go through it right now just because of time, but there it goes. So again, steps to buying, know what you want. I think if there's anything you can remember from my talk, know what you want, know what your goals are, and then find a policy out there that meets those goals. For financial security, understand company's financial strength. Brian talked a little bit about that. Find a licensed professional you are comfortable with. Compare policies, not on price, but also on benefits. Here are some resources that you can use. Again, you guys will have a copy of these slides. I love this quote. This is, I think, the most recent thing from the first presidents or from the church in general that talks about finances. Volunteer to read this real quick. Yeah.
Consideration should also be given to investing wisely with responsible and established financial institutions. We are also concerned that there are those who use relationships of trust to promote risky or even fraudulent investment in business schemes. While all investments carry an element of risk, that risk can be managed by following sound and proven financial principles. First, avoid unnecessary debt, especially consumer debt. Second, before investing, seek advice from a qualified and licensed financial advisor. And third, be wise.
Be wise. What can I say more? Right? Those are good things. So there's some other things that I've included in here that you guys can take a look through later.